Hello everybody, let's introduce our case. So the topic is, are OECD versus developing countries paying the right price premium, assessing ratings from credit rating agencies. So our case will follow this table of contents. In the first place we will speak about the introduction, after that the theory, the data, statistical model, the specification testing and interpretations, the results, limits of the study, the conclusions, and the sources. So let's speak about the introduction. When its expenditures exceed its resources, a government needs money in order to equilibrate its primary balance. A way to get money is to use securities on the financial market. We can add that the national governments are the largest issuers on the financial market. The risk of the government bond depends on the ability of this one to repay its debt to the investors. This ability is reflected by a rating, and according to this fact, some government bonds are considered as less safety than other ones. The yield required by the investors reflects their expectation about these factors. As the rating reflects the risk, the better is the rating, the better is confidence of investors who require a lower yield to lend money to the government. This means that countries with a higher rating pay a smaller interest rate to the investor than those with a lower rating. In this paper, we go a step further. In the first time, we will determine the rating of the different countries according to the model we have built. In the second time, we will focus on the premium paid by countries and the link with their rating, which is the exact research question as the following. Are OECD versus developing countries paying the right premium, assessing ratings from rating agencies? Now let's speak about theory. So a study showed of Vail, Lewis and Martin that between 4 and 9 variables provide sufficient explanatory power for the rating process. According to Antonio Alfonso study, he showed that 6 variables were identified as having a significant explanatory power on Moody's and S&P's ratings. These variables are the per capita GDP, the inflation rate, the real gross domestic product growth, an indicator of developed countries, the external debt to export ratio, and an indicator of default. A study of Bisson, Doyle, and Binnick also used unemployment rate in order to explain the rating. According to Butler and Fowler, the political and legal system influenced the rating of a country too. And to finish, for Miku, it was shown that the rating events have a short-term impact on the credit spread. Now let's introduce some explanatory variables from our model. So the first one we will speak about is the per capita GDP. The per capita GDP is an indicator reflecting the economic performance of a country. Countries with a high per capita GDP are more productive and they should receive a higher rating. Therefore, we expect a positive relation between rating and the GDP per capita. The second one we will speak about is the variable develop. The degree of development is linked to the per capita GDP. Countries with a high per capita GDP are often the developed countries. A lower probability of default is attributed to the developed countries. Therefore, we expect a positive relation between rating and the developed countries. After that, we will speak about the unemployment rate. A high unemployment rate has bad consequences. The government has to pay bigger amount of money for unemployed people. Therefore, we expect a negative relation between rating and unemployment. The last one is the government debt rate. The government debt rate represents the amount of debt that the government has contracted to finance its operations. Countries with a small ratio have a low level of debt compared to the GDP, and so they should be more solvable. Therefore, we expect a negative relation between rating and the government debt rate. The third point is the data. So, 2 rating agencies are considered in this paper: Moody's Investment Service and Standard & Poor's, knowing that there is an oligopoly on the rating market composed by the 2 agencies. The maximal possible rating for bonds of the best quality corresponds to the notation A for Standard & Poor's and Moody's, respectively. The minimal possible rating for bonds with extremely poor prospects correspond to the notation C. For the first part of our analysis, we will need depending variable rating. We use the rating given by the agencies Standard & Poor's and Moody's in 2004 for 79 countries, which in one end 30 of them are developed and countries, and in the other end 46 of them are developing countries. All countries taken into account do not have any missing value of the variables. We consider as developed the countries member of the OECD and as developing countries the others. Yes, so as we said, the GDP we see are the per capita GDP in gross domestic product. The values is the 1,000 of USD for the year 2013, and our source is trading economics. The predict sign are positive. For the inflation rate, the average of the last 3 years is in percent from 2011 to 2013. And our source is also trading economics, and the predict sign is negative. For the variables GDP-GR, the real GDP growth rate is also expressed in percent. The year of data is 2013, and the source is also trading economics. The predict sign are positive. The fourth variables is develop. The description is that it is an indicator of developed countries. It takes the value 1 for developed countries, so the member of OECD, or null, or there are null if there are developing countries. The year of data is 2014, and the source is OECD, the OECD website. The predict sign are positive. The fifth variables is the variable default. It takes the value 1 if the country is this a country with default story, and it takes the value null in otherwise. It takes the year of data takes the last 30 years, and the source is according Boiter and Rabari in 2013. The predict sign is positive. No, the 6 variables. Unemployment. The values is the average of the last 3 years in percent. The year of data came from 2011 to 2013. The source is once again trading economics, and the predict sign are negative. Seventh, the political stability. It was a determinate scale from 0 low to 5 high, and the value comes from 11 to 13, and the source of data is World Governance Indicators website. The predict sign is positive. The 8th variables is corruption. It was a determinate scale from 0 corrupter to 5 not corrupted. The year of data is the same as previous variables. The source is the website of World Governance Indicators, and the predict sign is negative too. The variable gov debt rate is the government debt to GDP. It was expressed in percent, and it is for the year 2013. Our source is trading economics, and the predict sign is negative. The last one is the current account. It was the current account to GDP. The values was expressed in percent from 2011 to 2013. Our source is once again trading economics, and the predict sign is positive. To determine our rating categories, we based ourselves on the work of Antonio Alfonso. We took the same classification for the dependent variable. One exception is nevertheless made. Indeed, we consider rating under B- or B3 for S&P and Moody's respectively, whereas Antonio Alfonso does not consider grades under B- and B3. We added tooth grades in the lowest category, class 5. So we have 5 ratings categories. The first one includes the rating AAA, and the last one, the fifth class, includes the rating BB plus and lower. It could be interesting to underline that the ratings given by the two agencies are more or less the same. In fact, it is quite similar. The Spearman's correlation are equal to 0.9785. So it was pretty close to 1. The first step of know the statistical model. So the first step consists in predicting ratings of S&P and Moody's using an ordered probit regression. An ordered probit is relevant because the dependent variable rating is an ordinal variable which takes numerical values between 1 and 5. This regression is made for each rating agency, but we also made for each agency a differentiation between developing and developed countries. By doing this, we took as assumption that there is a difference in the rating process for the developed and developing countries. So you can see in the following formula the rating of developed countries. So it depends on the GDP per capita, the inflation, the GDP in real growth, the variable default, the unemployment rate, the political stability, the corruption, the gov debt rate, and the current account. The second step consists in predicting the interest rate represented by spread 10-year bonds using a linear regression estimation. We made one model for S&P and another model for Moody's. So the formulas is spread equal alpha 0 plus alpha 1 rating developed and A2 rating non-developed. The variable rating is now an explanatory variable for the dependent variable interest rate. Rating EDEV is for developed country, so the variable developed equal 1, and rating INDEV concerning developing country, and so the variable developed take the value nu. Let's now speak about the specification testing and interpretations. So we will show you a stata table. As previously said in the presentation, we made 2 models, one for the developed countries and one for developing countries. So here is the case for developing countries. We also made an order probit for rating S&P. So here is the number of observation. We can also mention the LR chi-square. So the likelihood ratio chi-square, LR chi-square, is a test to determine if at least one coefficient is different from 0. The value of the LR chi-square depends on the number of variables compared to a model without any independent variables. Moreover, the p-value of LR chi-square gives information about the statistically significance of the whole model. Moreover, R-square given by linear regression has not an equivalent for an ordered probit. However, pseudo R-square are valid and useful in evaluating multiple models predicting the same outcome and on the same dataset. A pseudo R-squared only has meaning when compared to another pseudo R-squared of the same type on the same data predicting the same outcome.